Well, you certainly thought big and you created Stock Connect. And after stepping down as the CEO of the exchange, you decided to think small. And now the Micro Connect. So tell me more about Micro Connect now, after Stock Connect, how did that come about? Did you use the same framework that you just shared and apply to Micro Connect?
Micro Connect philosophically is exactly like Stock Connect. It's about connecting two markets that operate very differently. And the connect two market that artificially is being segregated because in the past, that's the only way to do so. It's really about breaking things down, because in the old stage, capital market essentially is the result of capitalism over the last 200 years. And when in the industrial age, economic activities on the ground in the real economy are very random, and there's very little investors can do at the grassroots level. So what we need to do over the last 200 years, the market is organized by essentially the biggest creation of the 19th century is really the corporations, that we actually organize capital. We actually say, let's aggregate individual capitals together and fund a corporate entity. Let the corporate entity deal with the daily operational element of running a business, and none of those individual activities at the bottom are visible. But we allow them to do it, and then create a certain accounting and financial regulatory rules to regulate how a company describe and disclose its activities into certain standardized form of GAAP and accounting principles and this and that, and then a whole bunch of regulatory and market rules to essentially informs on the activities of corporate through certain standardized disclosure, and then use the corporate as the underlying assets for us to trade as a proxy to trade economic activities on the ground. So that market is a concentrated market. We organize everything. So company has to be big enough in order to satisfy the Wall Street needs for information discovery and for delivery with exchanges, clearinghouses, and have to be in big standardized product like equity and debt, which is really a regulated, legal relationship between investor and investee. So all of that activity in the industrial age means that you can only deal with big companies. So therefore, our entire Hong Kong have 2,000 listed companies, a few hundred GEM. US has now 4,000 companies, China have 3. So globally, there are about 15,000 listed companies. This 15,000 companies are the only underlines that all the global capital are just trading with one another. And only 20% really have any trading volume every day. So we're really talking about a few thousand underlines that are becoming the symbol of trading, the basis of trading. The granularity of the disclosure is very poor, is time lagging, and requiring very complex accounting principles to regulate them. So we, as a professional in finance, we all wearing a big fake glass, and we were able to train as a CFA, and then we can understand all this company financials and all of that. But in the post-industrial digital age, it's like the internet transforming commerce. Commerce is like in the past, also like, the way everybody go to department stores. Only the department store is able to aggregate, product into together and become a standardized product and durable product, and people come in there to buy it. So therefore, the number is limited, the merchandise and diversity is limited. But then internet revolutionized commerce. The big platforms are able to deliver electronic, digital, internet, pricing, internet buying and selling, and then transaction, and then deliver logistically on the goods and the money. Today, China is on the verge of making this possible for financial services because the underlying economy is completely cashless now. Every single small businesses in China, they do not need to be part of a massive corporation in order for us investors to be able to see who they are, what they do, and how well they do, and whether they can be invested. We don't need all the franchisors to organize all the little shops together. They actually are very, very visible in terms of their revenue. Their cost basis and everything else can be very diverse, but their revenue is all consolidated. Every little restaurant, every little mechanic shop, every hair salon, they're taking either WeChat or Taobao or Zhifubao or another handful of other payment structures. Cash is already pretty much disappeared. So we are able to see their revenue. More importantly, the digitalization in China has happened in such a way that most of the businesses already have digital account interception devices or split devices. In there, you can actually take money directly from revenue before the revenue goes to the account of the little guy. So with this tool, visibility, interceptability, then there's no reason to organize them into a big company and wait until a big franchise to succeed with a few hundred shops. Why can't we directly be able to work with the franchisors, but directly investing in the franchisees, in the small shops? And that's really is MicroConnect. So what we are doing is to come out with a complete new market infrastructure. We're setting up a new exchange, a new marketplace called a MicroConnect Markets. And that market essentially has 5 key elements, but the most important is the product. The product is not equity, is not debt. It's called a DRC, a daily revenue contract. Essentially is that we are funding a capex of a franchisor on their new shops in exchange for a percentage of a revenue of their existing shop that is already in operation. So essentially we are short-term 2, 3 year, 4 year cash flow purchasers from them. And we list those cash flows on the exchange, and essentially investors, are able to now own hundreds of thousands of cash flows directly coming from the shops every day, digitally collected and cash delivered every day. And that sort of investment instrumentality and a market structure allow us to really invest back to basics, back to discounted cash flows, and essentially have a system where your investment is gone on the day, but as soon as revenue start to come the next day, you start to exit from that investment.
So you mentioned earlier, for all the big businesses in the big exchange, there are only a couple dozen companies that you could invest in. But for these small shops, if the numbers serve me right, China has over 10 million small shops, right?
China has 70 million registered small shops. 20% of them are franchised. So there are 14 million shops that are part of a franchise. Either some franchise are bigger than other. McDonald's would have thousands of shops. A lot of the, franchises have hundreds of shops, but they are tens of thousands of franchises that only have dozens of shops. And so we basically just investing in the shops, but we invest through the franchisors. The Chinese call this 顺藤摸瓜, meaning that we are actually investing along the franchisors, but we're not investing into the franchisor, we're investing in the shops. And we put a device, a collection device on every shop's bank account before the revenue hit their bank account. But we are not replicating a global, a nationwide technology system. We basically work with the franchisor that has successfully been able to collect their franchise fees as a percentage of the revenue of the shops already. So they need to demonstrate to us that they are in the business of collecting money every day from the franchisee under their operation. Then we say, great, we will invest in your, your shops. We give you money for your expansion, but you cut a percentage of revenue from each one of your shop and put that collection interception device onto those shops' accounts next to yours, so that we are able to collect what due to our investment every day as well. So that's essentially how, so we're talking about our aspiration is that over 10 years, we'll hit into a single percentage point of that 14 million franchise stores. So it's going to take us a long time to get to a couple million, but we're talking about at least hundreds of thousands and ultimately millions of underlines. Right now, for example, we have invested in 1,100 shops now. The average size of per investment is only 428,000 yuan.
This micro and small business economy is so fragmented. How do you standardize the process in scaling up the investments or selecting the right businesses to put money to?
First of all, we only, this works mostly only work in 4 sectors, in food and beverages, in retail, in services, and in cultural and sports activities. So basically require human services. Actually somebody have to be working in the shop and creating value on the people. Yes, they are very diverse, but they're surprisingly simple businesses. Because the reason traditional finance people think everything is complicated because the companies are complicated and they do their books differently. They do their books in different industries, but the shops tend to actually be very standardized and very, because, it's just a business, and, the revenue is a function of your space, of, how soon you turn your tables. And so it's actually surprisingly simple. And especially when you're talking about investing with the franchisors already solved 5 key problems, before we will invest it in their shops. Any successful franchisor will have to fix 5 problems first before they have enough shops on their franchise that we will consider. They have to have a good brand that works, tested. That you have to have supply chain. Most of the franchises, there's a supply chain relationship of goods and services. They have to fix their ERP and financial control so that they can collect the money every day electronically and digitally. And they have to sort out a good local location, a rent that is reasonable and a good location with good economics, traffic. And lastly, they need to fix who is going to be the franchisee, the little guy who work on the shop that can create and destroy value. So they need to do the 5 things. So we will be investing in shops that have already gone through this 5 tested by the franchisors. The problem with traditional finance is that unless and until this franchisor has at least 500-600 shops, they have no real prospect of being a listed company and then get traditional investor to invest in them. But they could be very successful franchisors, but just small. When they're that small, it is very difficult for people to consider how to invest them. They only have like a 15, 20, 30 shops. But that particular brand of shabu shabu works great in Chengdu, in the Western district of Chengdu, let's say. That may or may not work throughout Chengdu, and may or may not work beyond Chengdu in other part of Sichuan. And even if they're successful in entire Sichuan, they may or may not work in Jiangsu or Guangdong. So essentially what we do is to invest in them as long as they're successful, even on a smaller scale. But in that, even for the franchisor that have only 20 shops, those 20 shops are highly standardized, highly controlled. The franchisors have a system to collect the money. Their revenue is very clearly visible, and we are able to check the revenue before we make that investment. and the brand and everything else is all pretty standardized. So we basically just work with many franchisors, but we are investing in the shops on that franchise and not directly into the franchise.
I came to your office maybe a few weeks, if not a month or so ago, and I was shown a dashboard where you could literally see how each company is doing every single day, their revenue, and then you have this dashboard of, heat map.
Yes, we, it's, we will become a very massive data business because, we have very granularized data. Today we have 1,100 shops and 70 some franchisors, and there's a 900 franchisors who are continue to work with us now. So we will put money into hundreds of them over next year. But this year we probably will have about 150 franchisors in which we will be investing in the shops that they own. We have 11 shops. Every single Chinese provinces, we already have them, and they're crossed into 90 cities. And we even have we have 2 shops in Tibet. Obviously, we can never go to Tibet. So this is all standardized investment through the online digital, data system and digital fintech system. It's actually not difficult per se, but it's very difficult to organize the structure, because ultimately, unless you're able to scale this up to hundreds of thousands and to millions, and we can't have 10,000 people knocking on doors. Everything has to be able to be modularized electronically and digitally. So building the system to do it is very important. And we have now built a great system, and that system is just being upgraded every day as we speak. We modularize everything. So if there is an essence of our company, which is similar to what I do at the Hong Kong Exchange, is that you break things down. The more you break down them into smaller pieces, the easier for you to find way for them to connect. So essentially, we are breaking all financial services down to like a Lego pieces. Then we are able to reassemble them very quickly into a car, into a bus, into a building, into whatever we need it to be, because the foundational elements and modules are standardized. And it's very easy to standardize those modules for small businesses, even though our initial belief is always going to be, oh, gee, all those small businesses are so complex. They're not complex individually, but finding a way to do it in a systematic and data intensive and algorithm driven manner is what ultimately is going to make this thing succeed.
So by looking in this heat map, this dashboard, and with all the data, what do you see in China now? Is there a particular sector that is thriving, a particular sector that is not doing well? What's your gauge in the economy in China?
The good thing about this investment is that we don't really worry about it, because you're individual, you're literally, your business is to figure out what one shop in that location, what's the likely revenue over the next few years. We don't need to worry about this company's 前生后世, where they come from, where they're going to go, where they're going to be 10 years from now. Traditional finance, we conditioned ourselves and mindset into investing in big, massive trees and forest. The tree cannot die. The tree has to be forever. And that's why we have to do a lot of work to give us the conviction and confidence that the tree is going to grow into the sky. That's why we are willing to pay a premium for it, for those who have promised. But in real natural life, flowers and plants comes in the spring and they go away in the winter, but they come back in spring again. So the business that we're looking at are fundamentally short living life cycle businesses. And the lease patterns in China are 3 to 5 years. And large number of businesses don't renew the lease. They either wanted to move themselves or the landlord want them to move, or the neighborhood have changed and they need to really do another renovation or whatever else. So the investment cycle, the life cycle of the small businesses are just short term. So we need to do is to learn enough from a macro data and our precise data, finding relationships and developing actuarial algorithm for us to be more precisely developing insight as to that particular location. If it is a McDonald's, generally, and also we don't need to be that precise because our structure is not premised on accurately predicting how much you're making, because our the daily contract is essentially saying, Ronald, you want money, I give you money, but I want 8% of the revenue in order for me to get back my principal, let's say in 2 years. You're willing to give me my principal back in 2 years as a base level of distribution. And then we just basically use that to translate into how much your revenue you need to give it to me every day in order for me to collect in 2 years. Let's say that's the deal. Then you're going to worry about whether or not the shop is going to be so successful that 8% is you're going to give me, too much. I'm going to worry about whether it's going to be too little. So what we do is to negotiate. I need to get my money back first, and then as soon as my money is back, my participation rate drops down to a lower percentage. So that way, from your investee perspective, I'm like equity. You like my money because I'm permanent capital. If something happened to the shop, you don't have to pay me back. So it's less stressful than debt. But on the other hand, my return on my capital is tied to the principal in some relationship rather than completely like equity that can be all over, into the sky if you're successful. So that way you like us, but we investors like this because we're able to collect our money every day. So that's really how the whole balance works out. But then what we would just simply agree to a lower percentage of participation after my money is back. So if I get my money back very quickly, it drops down to a much lower percentage. If I don't get my money back until a little bit longer period, then it drops to a lower, but not that lower. So we simply, the contract is about a curve, and then it's digitally structured, automatically executed. So essentially, once I got my money back, it comes down to a lower level. So the cash return from the actual investment is in the teens. So for you, for the investee, it's completely acceptable. But for me, even though in the teens is not that sexy necessarily on of itself, but don't forget, we're getting money from day one. So that money get reinvested. So if you count the reinvestment, returns on the reinvestment of the money you collected every day, it's compounded. So the IRR for the investor is tremendous. So that's why this particular product is like Stock Connect and Bond Connect. It fit into the middle where you like everything about it from your perspective, and I like everything about it from my perspective, and we are able to get these two together. Otherwise, in debt, you feel stressful as an investee. But for me, most importantly, if you work out very, very well, have nothing to do with the credit providers because I only charge the interest rate. But if you don't do well, you're becoming my debt. So that's why you and I are constantly worried about each other. And if you're equity, you worry about whether or not, I dilute you permanently too much. So this way we both get what we needed. And that's why this thing is going to work. That's why it's so popular now. That we only have 100 people in Shenzhen and 30, 40 people here. And we actually don't do marketing. Almost all the clients are coming to our company. And today, then people are going to say, are you worried about only because they couldn't get any money anywhere else now because everybody is negative? No, that's not true, because anybody who comes to us, they need to open new shops. That's why they come to us. If they don't open new shops, they don't need our money because our money is very expensive for them, because I'm depriving them of their reinvestment ability because I'm charging it every day. But if they do open new shops, then our money is the best, which means that this whole pandemic is a big self-selection process for them. And those who are struggling are never going to bother with MicroConnect. Those who are knocking on our door because they are successful.
Thank you so much for joining today. And for all the audience here, if you have any questions for me, please feel free to send it over to me so I can share it with Charles. And in the meantime, thank you so much, Charles, for your sharing.
Thank you. Thank you very much.